And we are now live. So, hello and welcome to those of you joining just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. As I just mentioned, we'll be getting started on time in just a few minutes now. That is 10:45 a.m. Eastern Time. We'll be getting started with Mike Turner, who is currently in the Zoom room with me. Now, if you're looking for something to do while you wait, we do have Turner Capital Investments virtual booth available. They have information above the video player. And then there are handouts and some more links below if you wanted to reach out to their team to request more information. And with that all said, I know we still have some time before we get started, but I just want to let everybody know that Mike is looking forward to answering your questions today. So don't be shy during today's session. Feel free to share any questions you may have in the live chat box. It is located on the right-hand side of the video player. Before you type anything, you may see a couple of dots in that video player. This is just a privacy setting. So please go ahead and type hello, hi, anything you want into the chat box there, and then you will automatically be able to see all the other chatters. With that said, welcome to those just joining us. Just a few more minutes to go. We'll be getting started on time here at 10:45 a.m. Eastern Time. Thanks so much for your patience, and I hope you're enjoying the show so far. I see a few more people joining us, so I just want to pop in once more to say hello and welcome. We will be starting on time with Mike Turner at 10:45 a.m. Eastern Time. Feel free to check out Turner Capital Investments virtual booth in the meantime while you wait. And to those of us just joining, if you'll go ahead and just type something in the chat box, that way you'll be able to see all the other attendees and what they're saying throughout this session as well. All righty. Thanks so much for your patience and hope you're enjoying the show so far. Hello, everyone, and welcome. It's my pleasure to introduce Mike Turner. He's the president and chief portfolio manager of Turner Capital Investments. Now, Mike has a strong financial, mathematical, computer science, and engineering background. He takes a disciplined, rules based approach to trading through the use of his unique market directional investments. Now, to our live viewers, Mike hopes to answer as many of your questions as he can today. So please share any questions or comments that you have throughout this session in the live chat box. It's located to the right-hand side of your video player. And with that all said, Mike, I will hand everything over to you. I'll be right here if you need me, but the floor is all yours.
Thank you, Charlotte. Hi, folks. Good to see you today, and looking forward to chatting with you. There's a lot to go over today, and a lot of it will be a little bit foreign to your thinking. And I have found that folks, when you introduce a new concept that they've just not used before, there's a tendency to be skeptical, and you should be, because it's going to be something that you typically do not do. Almost everyone tries to figure out what is the best thing for me to be doing right now with my money based on what the market is likely to do in the future. That's just kind of what everybody does. And you listen to the world about it. You read all the news, about the economy, about the political environments, the war in Iraq, Iran, I mean, and what Trump might or might not do in the future, what the Fed may or may not do in the future, and all that sort of thing to try to get yourself kind of positioned to capitalize on what you think is going to happen. Here's the problem. Nobody knows what's going to happen. You can take the best analysts in the world. I kind of like to call them the best guessers in the world. And sometimes they're right and sometimes they're wrong. When they're right and you pay attention, that's great. You make money. When they're wrong, you're going to lose money. And I have developed a methodology that does not depend on, does not use, does not need to know anything about what the market's going to do in the future. Now, I know that's a little bit hard to believe, but that's a fact. What I have developed, and it's an AI-driven methodology, I'd say 85% of it is what we've developed internally, and about 15% of it or thereabouts has had the artificial intelligence brought into play, which has been a big, big help. It's certainly in the testing. But the process I want to introduce you to is how to make money in the market and never worry about what the future market is going to do, ever. You don't need to know or guess what's going to happen. Let's get into it. I don't have time to go through and read all this to you, so I'm not going to. There's one item down here at the bottom that I'm going to talk about a little bit, and that's correlation. I want you to be thinking about your portfolio, and if you're using an advisor or if you're doing it on your own, I want you to think about how diversified it is. But in that process, I'm not going to talk about diversification. I really don't care about diversification. What I care about is correlation. If the market goes up, does your portfolio go up? If the market goes down, does your portfolio go down? And if you're correlated to the market, and that's really all that matters, not correlated from a diversification standpoint, but correlated based on the market, then you're not correlated. I mean, you're not in an uncorrelated situation. You are correlated. You don't want to be correlated to the market. You understand that? You do not want to be correlated to the market. If the market drops 50%, you don't want your investments dropping 30 or 40%. You don't want that. And if you're correlated to the market, you will. So I'll get into that a little bit. So here's what most people think, that forecasting is good, but it's same thing as guessing, and it has a lot of emotion in it, and that ends up being worry. Do you worry that the market's at an all-time high and that it could drop at any moment? Are you worried about that? Are you worried about where the market's going to go? Okay, what's going to happen next? If Trump resolves all the stuff in Iran and the Strait of Hormuz is opened back up, does the market boom higher or does it sell off? Okay, you've got an idea about that, but it doesn't matter. So here's some kind of, I don't know, call them axioms. Those who have knowledge don't predict. Those who predict don't have knowledge. The current trend in the market will last exactly until it doesn't. That's just common sense. The market on a trend will remain on that trend until it's acted upon by an external force. That's just the adaptation of Newton's first law. That's just a fact of physics. Forecasts may tell you a great deal about the forecaster, but they tell you nothing about the future. Good old Warren Buffett. Trend lines matter, headlines don't. Ralph Acampora. And prediction is difficult, particularly when it involves the future. Mark Twain. So I'm going to go through how to never worry about the future market. And I've only got about 30 minutes with you. I'm going to try to get through this, but I would love to chat with you one-on-one if you want to talk to me about this later. There's going to be contact information at the end of this. Please reach out. I'll give you a call. You and I can discuss this. You can argue with me. You can tell me that I'm wrong, or I can explain to you how this process works. Here's some market observations. Markets go up and markets go down, and no one can accurately and consistently predict what will about those movements. No one can. You can't. I can't. No one can. Oh, here's the point. You don't have to. All traders want to buy low and sell high. Isn't that what you want to do? Buy low and sell high. That is nothing more than just common sense about what you want to do. Buy and hold only works if your risk tolerance is unlimited. If you lose 50% in a sell-off in the market, do you know how much you have to make back just to get back to even? 100%. When's the last time you made 100%? Now, here's the thing. During that move down and that move back up, you're not making any money when it comes to compounding. You don't make money in compounding, which is really an awesome part of being in the market, until you're making money higher than you were before. That's it. The key to long-term trading success is to avoid or limit losing trades. Everybody knows that. That's just common sense. The primary keys to profitable trading is knowing where the market is and how it got there. That statement right there is really the primary focus of everything that we do. The primary keys to profitable trading is knowing where the market is. You know where the market is. Right now, you can go look at what it's trading at right now. That's where the market is. It doesn't get any more complicated than that. And how it got there. That's the momentum. That's the how strong is the trend getting to where it is in play. Okay. Compounding is a successful trader's best friend next to avoiding major losses. Compounding is incredibly important. You know that. I'm not going to tell you how to compound. That's just a part of what happens. If you make 10% in the current trade and the next trade makes 10%, is 10% of that the prior trade, including the 10%. So it grows and compounds over time. The worst enemy you've got, and you've got it, almost every trader's got it, is emotion. You have an emotional thinking about what's going on right now. You're listening to me and you're saying, I don't know whether to believe this guy or not. And I don't blame you for that. But that's an emotional statement. I'm going to try to show you how we have no emotion in the rules that we have in play. So here's some wrong-headed thinking. Okay. Analyzing market fundamentals will help you create a better portfolio. That's just not true. You might think it's true. And here's how I can prove to you that it's not true. Fundamentals do not mean your portfolio. Good fundamentals does not mean your portfolio is going to go up. Next time the market tanks, you look at your strong fundamental stocks. Did they go down? Maybe not as much as the market, but did they go down? If they did, that's not uncorrelated. That's correlated. You don't want to be correlated to the market. Using technicals based on historical markets will help you create a more successful portfolio. You technos out there, I know you believe in that. Find a trend, find a pattern, whatever it might be in the past, and try to replicate looking at that. That's not going to mean that whatever you put together is going to do the same thing in the future. Past performance doesn't equal future return. Listening to the smartest advisors, forecasters and analysts in the world will help you make successful trades. No, it won't. It'll help you make some better trades, but they're not going to be right all the time. They're still guessing. All of those are guessing. Looking at what is driving the economy will help you plan your portfolio better. No, it won't. All these things are what maybe you have been using. They don't help you build a portfolio that is immune to the market. And I'm not talking about fixed income. I'm talking about taking advantage of the market. Realizing what political machinations are impacting the stock market will help you buy and sell better. No, it won't. That's still just another guess. Now, you may disagree with me on every single one of these, but stay with me. I'm going to show you why you don't have to putz with any of these. Being smarter about knowing what's going to happen next with regard to the market segments or sectors or stocks will help you make better trades. No, it won't. You do not know what's going to happen in the future. I don't worry about what's going to happen in the future. I don't worry about what's going to happen this afternoon, tomorrow, next week. I don't worry about it. And I'm in the market all in. Right now, I'm all in. I don't have a problem with getting all out. I don't have a problem with going all in into inverse index ETFs if the market goes into a bear cycle. But I don't worry about the future at all. Okay? Having a well-diversified portfolio keeps you uncorrelated to the market. That is a false statement. And for all of you advisors out there that are listening, and you look at that and you tell your clients that you've got a well-diversified portfolio and that'll keep you uncorrelated to the market, I just ask you one thing. If the market goes down 50%, how much will that portfolio go down? If it goes down a lot, it's not uncorrelated to the market. The following is what you need to build a portfolio that automatically adapts to any market. I call it dynamic correlation. Know where the market is, get the benefit of all the world's traders. Right now, the price of the market has everything that every advisor, company, and the world trader thinks about what's going to happen next. Know how the market got to where it is right now. Know how strong the current market trends are. Trend has to do with how strong the market is. Use logic, common sense to build trading rules. You need to have a rule for every condition in the market. I do. I don't make anything up. I trade by rules. I don't trade by, do I have a really good idea what's going to happen next? No, I don't. I know where the market is, and I know how it got there. Do not violate your rules 100% of the time. If you do that, you take emotion out of your trading, and you need to do that. Emotion will kill you. How to know where the market is and how it got there, we focus on two keys, the current market price and the current strength of the market. Okay, so who and what is the market? Well, individual investors, institutional money, hedge funds, pension funds, mutual funds, sovereign wealth funds, financial advisors, research analysts, algorithmic trading systems, bank trading desks, market makers, insurance companies, and on and on and on. Those entities determine what and who is in the market, and based on the price of the market today, right now at this moment, tells you the result of all of their analysis, all of their guessing, all of their PhD analysis of what's going to happen next. All of that is built into where the market is right now. Okay. So if they're doing all that work, why do you need to do any of it? You just need to know where the market is. Okay. All right. Building a strategy immune to the future. The steps. First, quit guessing about the future market. Quit listening to anyone who tells you what's going to happen. They're just guessing. Own the best of the whole market. I like to own a 50-50 mix of the S&P 500, the NASDAQ. Okay. Think about looking at the market 1 week at a time. Forget about this daily stuff. I'm not a day trader. I'm not a moment by moment trader. I'm a week over week. Why? It takes a ton of emotion out of the decision making. Rely on the fact that the current trend in the market will persist for a period of time, but can change unexpectedly. Develop a set of trading rules based on the common sense logic, not based on historical data. Do not build a set of rules that are amazingly good, successful, and profitable on the historical market. That's just curve fitting. That's all that is. That's data mining. Anybody can build a system that can produce millions of percent return by building a system that takes advantage of the historical market. That won't do anything for the future. Don't do that. Build your rules out of common sense logic. Be willing to buy or sell or short or move completely into cash depending on your rules. Yeah, we go to cash. We go to cash a fair amount. What do we do in cash? We go into money markets. Why do we do that? Because the market's not giving us a good trend and good momentum behind it. Okay, use common sense. Okay, here's a common sense rule. I want to buy low and sell high. That's just common sense. What's that got to do with historical data? Nothing. What's that got to do with the future? Well, everything. I want to be able to buy low and sell high. Who doesn't want to do that? That's just a rule. That's one of the rules. Okay. Without knowing how to do it, write down what you would like to see your portfolio rules execute. You need rules to tell you when to get in, how to get in, and when to get out. Write all of your rules without any guessing about the future. Don't sit down and say, well, I'm going to have a rule here that says if Trump does this or this or this or whatever, I'm going to do this or this or that. Don't do that. Write your rules as if you don't know anything about the future and you don't care about the past. Okay? Now, how to do it. Form a hypothesis on your logic, from your logic. Write it down, what you expect your rules to do. Define how you plan to test your hypothesis. Here's how I test it. I do what's called efficacy testing. I don't look at just profit. I don't look at just downside. I take my rules based on my theoretical thinking of what I'd like to have happen. Okay, let's talk about my sell rule. What do I want to do? Well, I don't want to lose too much. So that's part of my rule. I have a maximum that I'm willing to take in a loss. That's where I put a stop loss in. And I want to get out if the trend or the momentum begins to weaken. How much will it begin to weaken? Well, I've got a rule about that. How much change in momentum is enough to tell me the difference between volatility and a change in trend? Okay. Run your efficacy test on historical data, compare the results to the hypothesis. I want to buy low and sell high. That's my hypothesis. Now I'm going to run it against historical data. I don't look at the data to determine my rule. I look at my rule and then see how it worked historically. Different, quite a bit. Check for efficacy. Did your rules work as expected? Accept or reject. Do not adjust. If you said, here's my one rule. I don't have this rule. I only want to get out at the very top. How do you know when the top has been reached? Are we at the top now? You don't know. I don't know. Why would you have a rule that says I only want to get out the top? You can't do it. Write rules that you can actually measure. Okay? How we did exactly what? How we did exactly that, meaning that here's what we've developed. Turner Capital has developed. We incorporated systematic, rules-based analysis, including quantitative techniques. Our first non-trading rule was no tweaking to fit the data, no curve fitting. Then we built a set of rules from logic of needing to buy low and sell high, both in bullish and bearish and flat markets. We gave the methodology a name. I call it technical equity. We ran the efficacy tests on the entire market as far back in history as possible for a 50-50 mix of the S&P 500 and the NASDAQ. That's about 1990. Okay, here's the performance. Now, here's the thing. The SEC says, you know this, by the way. Past performance has no indication of future return. But do you know what everybody asks me when they look at my system? The very first question they ask, well, how did it do? How did it do in this date or that date or this range or what? They want to find out what it did. When we all know past performance is no indication of future return, that's still the first question I get asked. How did we do? Well, let's look at it. Now, right down here at the bottom is a table of how our methodology has done. I wasn't running this methodology in 1990, but I've taken all of my rules and started back then and brought it forward. I'm going to blow that table up so you can look at it a little better here in a minute. But here's what we did. We got 3 different kinds of portfolios for our clients. A 1X, a 2X, and a 3X. The 1X has no leverage. The 2X has a double leverage. What does that mean? That means that we're buying leveraged index ETFs of the S&P 500 and the NASDAQ that are 2X or 3X, meaning they don't go up exactly 2 times or 3 times, but that's how they're leveraged. And the 2X goes up about 1.5, and the 3X goes up about 2 times over time. Okay. So if we're doing really well in the 1x, we're going to do twice that in the 3x. We're going to do about 1.5 of that in the 2x. Okay. Results. They're based on a hypothetical historical simulation using our rules over a 36-year time frame of the real market. No fudging, no picking out various ones that work, all of it. All trading rules have been designed to be market agnostic, meaning they don't care what the market is. There's no looking ahead. It's looking at just where the market is and how it got there. Now, here's that table brought up a little bit. I know I've got about another 10 minutes. I'm going to try to get through all this. Here's some interesting stuff. I kind of like to look at the whole time frame from 1990 to current. And I look at the 3x because I like to look at that. That's where I got my money. You put your money in any of these you want. So it's up about 173,000% in that period of time. S&P 500 is up only about 1,900%. The TE, that's the technical equity index, that's the 50-50 mix, is up about 7,000 compared to 173,000. Okay, you got to think about that. Look at it so far for the year to date. 3x is up about 11. The technical equity is up about 4. Okay, I kind of like that. So you can go through all these and look at how it's actually done. This is real, honest to goodness efficacy testing, meaning we've taken our rules that are not based on historical data. We've taken our rules based on common sense of what we want to have happen. And then we have run it against the historical market to see how well it did and prove whether or not our common sense rules actually work historically. Does that mean every trade worked? No. Does that mean every year we were up? No. But look at the results that this has produced. And you look at the results that you have produced based on trying to look at the future and try to guess what's going to happen, looking at the past and trying to figure out how to adjust. We don't do that. We don't adjust based on historical data. So have we been looked at by a third party? Yes, we have. I'm going to read this to you. And the independent analysis using artificial intelligence-based tools evaluated our methodology across 36 years of historical market data. The analysis tested variations in entry conditions, exit conditions, filters, stop loss parameters, and did not identify not any alternative configurations that consistently improved results without introducing data mining or curve fitting. So the only way to make our methodology better is to go back and try to fit it to historical data, which is not going to help you at all for the future. This is using our rules that are totally agnostic to the past and to the future. That means they work in any market. These findings are consistent with the methodology's designed approach, which emphasizes rules grounded in observable market behavior rather than optimization based on historical data. This is a big deal. And I asked this third party, can you find a single thing that our rules could be improved upon from a total agnostic position on the market to be completely devoid of market timing in the past and trying to fit historical data? Can you find one thing that could improve on it? And they said they could not. That's a big deal. Okay. I've got about 7 minutes left, I think, thereabouts. Here's some more data. This is kind of like those of you who like compound annual growth rate. 1x is about 13, 2x is about 18, 3x is about 23, the S&P is about 9, okay, over the past 36 years. And for those of you who like to look at the volatility, the Sharpe ratio, the Sortino ratio, profit factor, win rate, those of you who really get into the nuts and bolts of looking at the stats, then this is interesting. You look down here at time and market. So we're about, what, 17% of the time we're in money markets, the rest of the time we're in the market. And then here's some headline information about the 1x CAGR and the 3x CAGR. 13% compared to 23%. That's a big deal. Profit factor, total trades, 97. Trades per year, we're only running a little under 3 trades per year. We're not doing trading every week. Think about that. What if we could have these kinds of returns, okay, and only make three trades a year? Think about that, okay? All right. Why technical equity? Okay, so you're sitting out there. You know, I've got a methodology. By the way, you can do everything I've done. It's going to take you a lot of time. It's going to be a lot of work. It's not easy. You can hire us to do it for you if you want, and I'd like for you to do that. We can help you. One area we can help you a lot in is correlation. Let me tell you what we do. We're dynamically correlated. What does that mean? That means in up markets, our methodology is correlated to the market. In down markets, our methodology is correlated to the inverse of the down market. Think about that. Instead of going down when the market goes into a bear market, our methodology is designed to go up when the market goes down. Not on every single trade, not every single moment, but in the overall trend, we go up with the market when the market's going up. We go up in opposite to the market when the market's going down. That's the design of the methodology, okay? On a systematic rules-based framework, we're logic-based, respond to the observed market conditions. We do not forecast, we don't estimate, we don't guess. And as horrible as this may sound to you, we actually don't care what the market's going to do next. We would love for all of our trades to do nothing but go up. We know that's not going to happen. You know that's not going to happen. You know the market's going to go up and down and up and down. How do you take advantage of that? We do. We're dynamically correlated, okay? Structure. Our minimum account size is 250 grand. We charge a management fee of 2%. The custodian is Charles Schwab, okay? So peace of mind does not come from predicting the future, which is what 90+% of the world does. They try to predict the future. I don't. This system doesn't. It comes from being ready for it. Putting it all together, the first key is where the market is. Second key, the strength of the market. Buy or sell or short or cover based on these two keys. The goal is simple. Buy low, sell high, according to the rules. There's that table again. Big time numbers. Okay. All right. Q&A. Charlotte, I don't know if you're there, and we've got what looks like 3 more minutes. Are there any questions that popped up?
Yes, we do have some questions here. I'll start with this one from Jamie. He's asking if you've considered using options as part of your methodology.
That's a great question. I get asked that fairly often. We do not. Options tend to have a lot of guessing in them. I'm kind of intrigued as a techno weenie that I am. I have really thought about can I take an analysis of options and apply the same functionality of not caring about what the future is? Don't know. I'm intrigued by it, but no, I haven't done that.
Thanks,
Any other
Mike.
questions?
We do. Let's see if we have time for one or two more. Now, this one is from a newbie trader. James is asking if you were starting from scratch today, younger investor in trading, learning the markets in 2026, what would you focus on mastering first? Would that be tools, data, coding, or something else?
If I'm starting out, and I wish I was in my 20s to be starting out with what I have learned. If I was starting out, the first thing I would do is try to get myself to understand the very simple position that knowing where the market is, that you can measure, you don't have to guess at it, is number one. And number two, you need to look at the momentum of how it got there. Momentum can be measured in a number of different ways. You can just go to AI and say, how would I measure the momentum of the market? It will give you a dozen different ways to do that. Those two things will do more for helping you plan for building your portfolio than anything else. I guess the third would be stay uncorrelated. Go up when the market goes up and have an unlimited upside and a floor. That means the stop loss. When the market goes down, be ready to go into inverse index ETFs. And I only use indexes. I don't trade individual stocks. Okay, they're too emotionally driven. Do we have time for one more?
I think we do. This one's from Natalia, and she's asking, can the investor get to choose which stocks they want you to trade if they're working with you?
No, you can. We're only going to work that. Now, there is a way to choose which of the indexes. We've got a 1X, a 2X, and a 3X. So if you come in and you say, I don't like this leverage stuff, don't understand it, don't like it, then you go into 1X and there's no leverage. But it's still going to be the S&P 500 and the NASDAQ. We don't get into any other stocks. It's just those two indexes. So you can each choose 1X, 2X, or 3X. And we've got some clients that are in all three. We've got some that are in two out of the three. And we've got some, most of them are in one of them.
Well, Mike, thank you so much for a
You bet.
fantastic session. And for those of you watching live, be sure to reach out if you have more questions for Mike and his team. Their virtual booth is available for the rest of today. You can request information through there even after this session ends. So, Mike, again, thank you so much for joining. Fantastic session. Looking forward to next time.
Look forward to it. Take care, folks. Talk to you soon. Bye-bye.
Absolutely. Be sure to stay tuned as we have more in store for you in this Money Show Virtual Expo. But I hope everyone has a wonderful rest of your day. Take care.